Welcome back. Would you please confirm I'm audible? Welcome back. I'm audible. Hello. Welcome back. I'm audible. Hello. Okay, guys. Let's continue with the same topic, transitional relief. So I'm looking for a quick response. I'm audible. Okay, so now, guys, let's continue with the same topic, transitional relief. Okay. So let's continue our series. See, I'm continually monitoring the YouTube. You please may send the text message if anything. But I already shared the screen on both sides. I appreciate what if you share the question over there. So because that is I'm looking for the question answer.
Recording in progress.
Monitoring the YouTube. You please may send the text message. Good afternoon. Welcome back. Today our day number 10th. May 24th, part number 25. The topic is the transitional relief, transitional rules under UAE corporate competitions. So this is the transitional rule, the agenda, the topic, the second session on that today. So we already covered the major fundamental of the transitional rules. So now, as a continuing the same topic, we are on the second part of the same topic. So let's dive into that and continue. We left. So here we are focusing on the transitional. Okay, so now we are doing the Corpotex competition as per article of the city law is 33. Then our agenda under that is the election. Under election, we are on the unrealized gain. So this is our topic. So under unrealized gain, so we have the transitional rules. Under transitional rules, we may have the investment properties, immovable property. We are focusing on that financial asset, financial liabilities. Okay. So under that, we are focusing to cover the excluded gain. So how to calculate the excluded gain? So during the first tax period, so the qualifying asset mentioned immovable property, intangible assets, financial asset, and liability. Then the prerequisite, even the last part, the one of the participant is saying the revaluation. So here the prerequisite are the preconditions, are terms and conditions. The asset must be on the cost model in our books, and it must be purchased on the first before first tax period, and then it's expected to sell in the future at the gain. Okay, expecting to sell in the first tax period or later on. He's saying the next condition, you are expecting asset have the value to sell in the future, maybe the first tax period or afterward in the future. These are the prerequisites. So here we are so far the covering. We discuss up the transitional gains on immovable property, and we were discussing the second method. If any question or any sound, anything, so quickly please reply on the YouTube. So I'm looking over there. Uh, but apart from that, I'm assuming everything is going well. So here, I appreciate volunteer one of guy who will keep make the comment and for my understanding if everything is going well. Okay, so at the actual sales, the second we are discussing the second method. The second method we said, okay, if the same asset is sold at 700 at actual sale, then we said the we have to less the same here. This part, the less part is same here and the same here. What is that same? We said the cost of higher of cost or net book value. Okay, the same we said, okay, the cost is the 500, net book value is 350. We said we will take the cost. Okay, so now our our gain is 200 versus here the gain is 150. This gain we calculated based on the direct method. This is the direct method. The gain is on direct method. This is the proportionate method. Proportionate method. This is the method 1 and this is the method 2. Okay, these two methods we are using, and but here this one we calculated at the first tax period, and this is we calculated at the actual time of sale. But now we have the choice. Now we have the choice at this stage when we actually sold, and whichever giving us the more gain, because we are looking for the excluded gain. Excluded gain. So which gain is more? Method 1 or 2? So which gain is giving us the higher value? This is the method 1. So just let me know which gain is giving the higher value. So here if we look, the 200 million is the higher. So that we will minus from our tax computation. Right? So this is the proportionate. Now we'll understand what is the proportionate method. Okay. This is the first step we clear. But next step, so proportionate. Okay. So we'll come later on that calculation. We will cover that how to calculate. So as a simple, we will understand. So total number of years of the ownership, total method, what is the total number of ownership? If asset is owned, let's say from 2020 till 2025 December 1st January, so total is 6 years, right? Ownership. Now the ownership, or we can say till before first tax period, so maybe the okay, till 2020. Let me reverse this. I'll make the simple equation. If asset is purchased on 2021 until 2023 December, how many years? 3 years. Okay. So now asset is sold in 2030. December 2030. How many years? 10 years. So wherever we'll do the calculation, so let's assume this asset is sold in 2030, and assume this asset is purchased in 21. Okay, just assume this asset is 21. So if the asset before the first tax period, is 3 years, so what we're gonna do? 200 multiply 3 divided by 10. Why? Because we have to calculate the excluded gain. Right? So would you please anybody do the calculation how much the figure is coming? Because direct method we have 150, and let's see from here how much the figures are coming. I appreciate if anyone do this calculation. Yes, Prabhu. Yes, guys. I appreciate if you give me the figures, how much. So if we do the 200,000, 200 divided by 10, 200 divided by 10 is coming the 20. If we multiply by 3, it's coming 60. Okay. Is coming the 60. This is the total gains, and what we have to calculate, the excluded gain. So if we do this, so it's coming the 16 million excluded gain. And here is the 150 million. So which one is higher? Now this figure is good for us. Okay, so let's come to the next. We have the example with detail. We will come on that. If anything is missing, that will be covered over here. Now the transitional gain on intangible assets. So here is the intangible assets. So on transitional gains on intangible asset, there is only one method is available. Only one method is available, and that is proportionate method only. On immovable property, two method, transitional intangible asset only one method, that is the proportionate. And the second factor over here, numerator maximum 10 years. The gain we can exclude up to 10 years pre-owned ownership. Okay, so what is the numerator? Let's say the total asset ownership period is 20 years. So upper is the numerator, this is the denominator. So which means up to this we can calculate the excluded gain. Right. So now let's see intangible asset to method to excluded gain. What we are doing excluded gain, and this will happen only actual sale. Here we don't need to have the valuation report. For intangible asset, we don't need to get the valuation report because that first method is not available, and this will applicable at the time of the actual sale. Again, minus higher of original cost or net book value at the first tax period. Okay, so at the outcome will be result. But here the valuation is also involved. Here is no valuation. Why? Because this is only the proportionate method. Direct method is not available. So now the number of days property is owned at the first tax period. Here again we copy the same, but if we talk about the intangible asset owned, first divided by total number of ownership. He's saying on here maximum can be 10. If is a 8 is good, but if is a 12, we cannot, we limit up to here. Excluded gain in intangible asset owned prior to the first tax period, maximum 10 years. Our ownership, if before first tax period is exceeding 10, like 12, 11, 13, so we can put 10 only. But if our ownership before tax period is 87 something, that we can keep the 87. This is in the limitation as per the law. Now our third point is the transitional gain and losses on the financial asset or the liabilities. So method only excluded gain. Okay, so sales are deemed at market value. Here is only one method, and which method is this? Is sales or deemed value at the first tax period less original cost. Okay, less original cost. What is the difference? It is a deemed value or the value at the time of first tax period, then the original cost. Here the cost is we are doing the minus, but here we are looking for higher of. Here is also higher of original cost and net book value, but here is also the same higher of, but here we said original cost. The word original cost, there is no net book value over here. Then the outcome will be excluded gain and loss. Transitional gain on financial and asset sales are deemed value at the first tax period. Then we have to minus original cost. There is no net book value concept over there. Okay. So this is our third. The excluded gain, not higher of. This is the different from here and here. Here they are considering only the cost, original cost. There is no net book value. Okay, let's do one example in this regard. So let's do one example for the same. Ministerial Decision 123. Okay, so we are covering and the city Article 20, Article 20 of the Article 61 Transitional Relief. Okay, Article 20 is dealing with the taxable income competition, and particularly on this transitional relief, Article 61 is dealing on the transitional relief. And then and in addition, we have Ministerial Decision 120 on the transitional relief. So this is what I'm saying, city law, just repeating how this is not only one article or one law, city law, Article 20 dealing city competition that we are doing. Then along with that, whatever. Okay. Article 20 of city law plus specifically on this area transitional relief Article 61 plus ministerial decision 120. This is the formula, or this is the formula I'm saying just for understanding which how many articles are ministerial decision applicable on one single topic. If you want to read, so read in this way. First read this, then read this, then read this, then as a combine you will apply over here. Okay, so let's say the cost model. The cost model, the ABC company, profit before tax, how much? Profit before tax, how much? Okay, the cost of immovable property. Immovable property, what is this? Cost. When? 1st January 2021. How much? 100,000. Then the lifetime of property, ownership period, I can say, or the, okay, life, we can write the life, 10 years. Then first tax period is December 24. First tax period is, right? Asset is sold at 30th June. Now they're saying asset is sold at 30th June, sold, actual sold. Asset is sold 150. Okay, we didn't write 150,000 and is using the accrual based accounting. So these are the facts we pull out from there. So now would you please do the calculation? Would you please do the calculation and calculate the excluded gain? What is the excluded gain? I appreciate your participation and do this calculation. Uh, I'm looking for your answer, guys. Prabhu is gain is 330,000 almost. What is the mention? Anybody else? Anybody else? See, if you not do the practice with your own hand, so it will not be retained with you. Even you understand very well, but apply the calculation with your hands to retain this understanding with you or to capitalize this learning. Okay, so let's continue with our topic. We are calculating the excluded gain on disposal of asset. First method on the gain we are taken on the excluded gain on this 1st January that we are calculating. So what we said, our sales are deemed value of 120. Then we are saying less original cost or net book value. So this is the our original cost. Okay, this is the our original cost. Then we have to calculate the net book value. So which one is higher? So if we are calculating 120 is our deemed value. So now if we see the we have the 100,000. This is the cost. So now we have to calculate 3-year value. So if we divide by 10 per year, depreciation will be 20,000. So we have to calculate 3-year depreciation. 20 into 3, it would be 60,000. So if we see the net book value, 100 minus 60 will be 40,000. So now the thing take the higher off. So higher off. What does it mean higher off? If net book value is a 40,000, okay, in books after depreciation, this is depreciation, okay, accumulated depreciation, and the asset original value is 100. So which one is the higher of 100 or 40,000? So 100,000. So we said higher of is 100. 120 minus 20, 20,000 gain. So instead 100,000, if we take the net book value after the depreciation, So we have the higher excluded gain, right? Instead 100,000 we minus 40,000. So our gain will be 80,000. This is good for us, but the law they said higher of. That is good for the tax authorities. In favor of tax authority, this 80,000 is excluded gain. We don't need to pay tax on this. But now, as the outcome of the higher of is 20, so we will not pay tax on 20 due to higher of. The word higher of is very important. If it's a lower of, it's good for us. Now, sometime higher of in our favor, sometime higher of in the tax authority favor. It depends scenario to scenario. Okay, now this is the deemed sale we calculated. Now this sold in the 2025. Okay, this is the actual sales. Right? So again, we will go higher of net book value of, then again, if we do the calculation another 4 or 5 years, so the net book value will be reduced. So we know higher of will be 100. So we sold at 150 and gain is 50,000. From first method, we have 20,000, and in this method, we have the 50,000, but this is the total gain. This is the total gain. Now we have to calculate. Now we have to calculate before tax. Now we have to calculate before tax ownership. Number of days before property is owned and first tax period divided by total number of days of ownership. So Prabhu, give the answer. Let's see that this is the 50,000. I'm not going to take the days. I'm just taking the years. Simply the years, how much we purchased 1st January. Okay. So before tax is a 3 years, just for the understanding. And we sold, when we sold 30th June 2025. So what does mean is 4.5 years. Right? This is the total ownership. This is the before first tax period. So what I'm going to do, this divided by this, we will do, but actual calculation will go by number of days. Just as a simplicity, as an illustration purpose, I just made the years. But actually, it would be on year and and the number of days calculation also given by the tax authorities. So that also keep in mind. So 50,000 multiply 3 divided by 4.5. How much is coming? How much coming? 33,000. Hope you understand this concept. This is the excluded gain. This is the total gain. This is the excluded gain. Now we will see 20 is higher or 33 is higher. How we will choose? 20 or this. So still tax authority is given us the option, we will choose. So this is the higher, we'll choose this. Okay. Sales actual value is 150, net book value of disposal of asset. Okay, so now we have to calculate the depreciation, right? So depreciation for 5.5 years, so every year is a 4.5 years. So if we do 20,000 multiply 4.5, okay, so is only the 5,000 value is left. Am I right? Just do this recalculate. No, I think that this is the 10. Sorry. This depreciation per year will be 10,000 because 100,000 property. So it will be 10,000. So if we calculate, so let's calculate here. So this is also for 3 is this number calculation we are just taking for understanding. Okay, so here the 10,000, let me correct this. Is 30,000 is per year is depreciation 10,000, right? So if we are calculating the depreciation is, so this will be 10,000, it will be 45,000. So total is 100 minus 45,000. This is the net book value at the disposal. Okay. So now we are saying profit on sale is 95,000. Okay. This 95,000 already added over here. From this 95,000, how much the gain to be exclude? 33. 33. So we'll minus 33 from here. From profit before tax, we'll minus 33. Why? Because 95,000 is already added. So how much the excluded gain? 33. So this will minus. Any question, please? Any question, please? Okay, so now transitional rules applying on intangible asset and liability which are recorded on cost model only. See, this yellow highlighted is for the important notification or disclosure or information part. So always keep focus on this yellow highlighted. It will apply only the cost model. Okay, so far if you skip this or you overlook this cost model word, your whole competition or whole idea of the transitional rule will be inappropriate. Your way of thinking will be inappropriate. Okay, the qualifying asset. So now we already learned, but now again we are prerequisite. We gonna understand. First, they said qualifying asset. What is the definition of qualifying asset? First condition. First condition. There is Prabhu is saying is not. I shared the screen. Let me see. Okay, now it's saying I didn't do anything. So maybe some. From my side, everything is fine. So anyhow, you can. Okay, the first condition when we are deciding on which asset we will apply this transitional relief on qualifying asset. On qualifying asset, first condition, what is the first condition? On cost model. We discussed today morning IS 16, IS 38 as a IS 40, okay, IFRS 9. So we took the overview and we wish to understand, okay, these standard may give us option on the cost value, cost model and the fair value or the revaluation model, but only those assets where we opted the cost model is a qualifying asset. We have 50 property, but 10 property on cost model we will use only on 10 properties. The rest 40 we will not. Okay. This is the alignment with the IFRS. Second condition, purchase before first tax period. This is the second condition. Okay. This is the third condition. This is the third condition. 1 of 3, 2 of 3, 3 of 3. So qualifying asset. Okay, the qualifying asset, under that we will, it is the same, but we're gonna discuss the immovable property. It will be one of three. Here we discuss conditions, terms, and conditions. Earlier we said prerequisite. If this is met, so then we shortlist the qualifying asset. Now under qualifying asset, the next step, what we are discussing, we are looking for the asset into three categories, right? This is the conditions. Now, if we shortlisted, okay, these assets are qualifying, then we have to separate into three sections. The first is the immovable property, where we will look into that PPE, property, plant, and equipment, own use. Then we may have the investment properties. Investment properties, land and building held for rental. This is the IS 16 and this is the IS 40. Land and building held for rental and capital appreciation, they particularly looking for this. But if it is on cost model, the cost model is very important. If in our books this is not on cost model, then it may not be qualifying asset. One of the question was from Prabhu, if in before, let's say he was trying to say 2020 we purchase on the cost, okay, and in 2022 is the revalued. See, another important part, every year you cannot change this accounting policy. You will keep on the cost or keep on the revaluation model, that at the company level, at the asset level or class of asset, you have to define your policy. Okay. If you already made in 2022 the revaluation, okay, then your books are, that particular asset in your books is not anymore cost model. So the asset will be out of qualifying asset. So hope this point you understand. If we're changing, then see, even the PP, property, plant, and equipment, these are the three different classes. Even under same standard, this is the three different class of asset, which means all the asset will be on same model. If we kept on this class, it all should be on the cost model. If you kept on the revaluation, all asset under this class will be revaluation. If this asset you kept on the market value, then all the asset under this class will be market value. Although the same standard, but there is a three different class of asset: property, plant, and equipment. So keep in mind, so we cannot frequently flip the our accounting policy. Hope I answered your question that previously was raised. Okay. Intangible assets. So now the second class of asset is this intangible. What is that? Software, copyrights, patent, landing rights. At airports like the UK, British Airline, they have the landing rights. Qatar Airways, they have landing rights. Or the Saudi Airline, they have the landing rights. Or Air India, they have the landing rights. Or any or Pakistan Airline, they have the landing rights. They have certain agreed contract for 10 year, 20 year. Maybe if somebody secured the contract a year before, the price is different and they continue on the same. Okay. But now if somebody take the lending rights of the contract with the UAE immigration, the airport authority, okay, civil aviation authority, today price is higher. Today price will be higher. So then that's why they're saying these are the qualifying asset and the value may differ. The next is the financial asset and liability. Okay, we'll continue on the next slide, this part. This is the same thing we already discussed. Immovable property, land and building, vending machine, a turbine. Then we said the PPE transitional apply here only on cost model. The same. If we follow the revaluation, we cannot apply here. Same investment property. If on cost model, yes, we can apply. If it's on fair value, we cannot apply. So the principal difference you understand, if that asset is on cost model, is good to go. Is coming under qualifying asset. This is also qualifying asset. But if we record in our books on fair value, that asset is not meeting the definition of qualifying asset. Yes, please. Any question? See, the Prabhu, this question belongs to IFRS, and IFRS is a standalone, is a different learning part. Okay, if we start discussing, then many conditions are there. So we are just highlighting what is the IFRS over here. Your question, as I mentioned earlier, you have to look in the particular and look into that. What are the IFRS guideline on that? Because that is not the city law. City law is saying what are the you did in IFRS. Look from that perspective. Okay. See, always keep your position as a tax accountant or the tax consultant, and the second position give to someone else, even in your own organization, even to your colleagues, where you will say, okay, this is the law is saying, let him come back with the IFRS guideline, because the person, he will defend the IFRS and you will defend the law. To learn that, so your learning will be much more because you focus on the taxation perspective. Currently, if you are interested, there is a taxation society, one of the group or the community they created private. So they are running, I believe, the IFRS master classes, and the cost is also very economical. You can join them. Okay. One of the participants, I think the Amer is also a member of that community, and maybe he can help you all, or you can send me. I will share you the contact person. You might join them and see if you are interested in IFRS. That is not the academic institute, but one of the learning provider of the community. Anyhow. The PwC also offering the IFRS classes that you also can join, but that of course it will be expensive. Okay, come back on that. Financial instrument is an agreement that gives rise. So this is the financial instrument. Okay, here we are understanding. Okay, what is the financial instrument? Asset of one entity, same time. If asset is of one entity, so same time it will be liability of another entity, right? So you have to see, you are looking the books of the which entity, which organization, from the asset perspective or liability perspective, because same item or the same transaction. Today morning we say is same property, plant and equipment. For one entity is the inventory, another is for the PPE. Okay, the same machine can be inventory for one entity, and same machine can be property, plant and equipment for another entity. Same way, financial instrument, the entity for one entity it can be asset. Under the financial asset accounting, so under financial asset accounting, there is another further category. What is the further category? We might given as the equity investment, purchase of shares, purchase of shares, or we might give as a debt instrument. Like we are discussing the IMAR shares, so that is the equity investment by purchasing the shares. But if we given the loan to someone, okay, so that coming under the debt instrument, and even the shares, redeemable shares, okay, the preference share, redeemable preference share, that is also part of the debt instrument, and we learned in the previous session. Purchase of bonds, debenture, and any other company receivable. Is saying any other company receivables. What is that? The our trade receivable is also the receivables, right? That also come under the debt investment. Okay. Now the other part we understand asset of one entity and the liability of the another entity, right? The same financial instrument can give rise to the asset of one entity, and the other entity is the liability. Okay. So now, if we look the share purchase, so how it will be work? The share purchase may be fair value through profit and loss, short term, unlisted stock at cost. So here we are, what we are looking. If we seen in the audited financial statement, the cost, this is the qualifying asset. If the financial fair value through OCI, it's long term. So which we will consider. This is through the fair value, the first fair value, second fair value. So it's not only the cost is relevant for us. If the cost is there, we can segregate that asset. The second debt instrument, again, we have to look into that. The debt instrument, if the fair value, no, either through PNL, either through OCI, irrelevant. But because this is the fair value, this is not meeting the definition of the qualifying asset. But no, and this third one, yes. Why yes? Cost model. So these are the how to classify, how to understand, how to segregate the asset for, categorized under qualifying asset. Any question, please? Any question, please? Okay, so this next slide is also very important, although we already covered this slide previously. Yeah, this is, I believe, we covered, but again, I'm just going to. Okay. Again, the transitional rule on the qualifying asset. The first measurement, the first is a measurement test. The yellow highlighted is the key points that we have to test, although we covered the same. The asset and liability kept at cost model. We should focus on the cost model, right? The first is a transitional gain on immovable property. There's the two methods. So this two method we learned. Okay. This the two method we learned. So if this is in method two, transitional gain at the start of first tax period, that will excluded gain from gain on disposal. Okay. So then we have the method one that we also understand in detail. Okay. In method one is the deemed is the not actual sale, then higher of net cost or the net book value. This is what we understand, and we have the gain. Then method two, this method two only the difference is coming actual sale. Okay, again higher of net book value cost at the first tax period. So this we already did in the calculation and the previous. So here is the important is the direct method, only the company or the property that you have, it should be approved from valuation you get from the certified valuation companies. Mostly RERA issuing the certificate to the valuation company in Dubai. Another um, Emirates may be the land department of the each Emirates. So this is the important. So the company or the valuation company must be registered with the relevant Emirates under the relevant land department, or they have certification, so that will be accepted for the FTA. This is that, and the second is the holding test. So we are categorizing the measurement test. We set the cost, then we set the holding test. Holding test will be before first tax period. Okay, then third test we are saying the gain expected to be sold during or after first tax period. So if asset is sold at loss, so do we have to do all this calculation? No need. So our concern, if it's coming on gain, then that is the important. We are reducing our taxable income while calculating the excluded gain. The transitional gain on intangible asset, we also learned that how to do that. All the method we understand. Then here the two things, only one method, that is the proportionate. That is the proportionate. On the immovable property, there is the two method. Here is only one method. Okay, so and here the condition is maximum 10 years. This is the another important factor. We are revising the same that we covered previously. Now, if you want to go and see the accounting standard by FTA guide, so please note down or search this. You will find the accounting standard guideline from the FTA, and that is irrelevant while classifying on cost, which standards are dealing. We see in the overview of that standard also. Again, the important part, irrevocable election at the first tax period, qualifying asset and liability. So the same, it's again, its asset is recorded on the cost model. There is only one method, excluded gain. Okay, there is no cost versus net book value. If you see, only the original cost. Here is also we have the higher of, see, higher of, because original cost is also there, net book value also there, and here is also higher of. Here also will be higher of. This is higher of, because here we have the original cost and net book value, but here in the qualifying asset, they're saying the actual sales, the deemed sales at the first start of tax period plus the original cost. This is the way to calculate, but only not higher of net book value and cost, only the original cost. Then we have the equity instrument. Just now in previous slide we seen the purchase of share other company. This is the equity instrument. Unlisted stock at cost. Okay, even we under equity investment we have the share that not yet listed in the exchange, that we will consider at cost. Okay, so then debt instrument, that also will learn that. Purchase of bonds, shares, these shares are different. These are not the ordinary shares. These are the preference, by name will be shares, preference shares, redeemable preference share, debenture, other cost, and we have to look into that. It should be on the cost model. Okay, so now let's see the next. We already covered this example. Okay, so ministerial decision rules. This is the method 2. See, this is the intangible asset. Intangible asset, and versus this is the previous example were for immovable property. Okay, here we have two methods. Method one, we understand method two. We did this calculation, and this is the intangible asset. We have only one method. Only method two to calculate market value at the rate of sale 150. Higher of the cost will be higher of gain is 50,000. Then we have to do this calculation. This also we learned in the same fashion, but just as a point to highlight, only one method is available on intangible asset. So the second important point, maximum 10 year before first tax period that we can do in calculation. And this is the, of course, irrevocable election. Of course, this is irrevocable election. Okay, so now if you want to see the reference, you might search this Ministerial Decision 120 adjustment under the transitional rule. Okay, so 120, MD 120, you might go and search. So let's see the one example, asset purchase in before first tax period. The taxable person acquired an asset in a period prior to the first tax period. Now another arm length amount. This is the very important arm length. Why? Because if you purchase from a later party, then transfer pricing rule will be applicable. Now the second condition, asset recorded on the historical cost. So just we are revising our learning. We're saying before first tax period, this is our learning. Then we're saying it should be arm length. Then we're saying it costs. What is the learning we're applying? Qualifying asset. If asset is not coming under qualifying asset, then we will not apply this. Okay, now we have the under historical costs. Would you please calculate this excluded gain? I appreciate if you calculate the excluded gain. Prabhu is there, Muhammad Ifam is there, Amir is there, Abdullah is there. So please calculate this. And today will be our last session for this month because next Eid holidays are coming. So then we'll come back, I think, in June first week as per the sequence, whatever the date. And the May end, that will be, as earlier communicated, will be not available. Each month end will not be available. Okay, let's see the under the historical cost. Opening balance sheet at the start of first tax period for the same original cost is 1,000. So they're saying there's a no depreciation. Just make for easy understanding, even though market value of the asset is there. So now there is no depreciation. So which means original cost and the net book value both are same, that is 1,000. So if we apply higher of, both are value are same. Yeah, so one of response is there. No. 700. Okay. Let's see. Let's see. I appreciate other participant also to be replying, and I appreciate if you can reply on the YouTube, because that I can looking into that. Here sometime if I'm not look into that, your question will be missed. Okay. At the first tax period, even the market value is this. We have the market value. This is actually the deemed market. Market value means at the first tax period is a deemed, means assumed, because this is not actual sale, just a valuation. Okay. During the first tax period, asset is disposed of. Let's say 2024 is the first tax period, and asset is disposed of. How much? At 2, right? This is the thing. Realizable taxable gain is 1200. How? Because original cost and net book value, how much? 1000. So this is coming, the gain is 1200. So now, if the gain is the 1200, now we have to calculate the excluded gain. Sale price is this 22, and the cost is this. Okay. Out of which relate to prior first tax period. Okay, that is coming from here, because we minus 1000, so it's coming 700. And now with the 500 appearing subsequently, right? So what does it mean? We are calculating the excluded gain. Total gain is 1200 minus 700. But this figure we already have it. Okay. If you want to see the taxable gain, then 700 minus 500, this is the taxable gain. But what we are looking for, the 700, why? Because profit before tax, in which already these gains are added. So what we have to do, we have to adjustment. What is the adjustment? Excluded gain. How much the excluded gain? We look into that. Okay, 1200 versus the 700. So we have to calculate the apportion that everything. So we at the end we will see, okay, the 700 is the gain excluded. We will minus from there. Right. So this is our primary learning under this. The asset is recorded on the fair market value. Now what they're saying, the asset is recorded on the fair market value basis, considering the same facts. If alternatively the taxable person apply the market value basis, the asset will be reported in the opening balance sheet at the market value. The realizable taxable gain will be 500. So now, just as the understanding, and Prabhu have the question by looking to other way round of the table, to understand if asset is already recorded on fair value. Okay, if the cost model, we will calculate. Asset is recorded on the fair value, considering the same fact. They think everything is same. Just assume that it's not the cost, because the cost was this, right? The cost was this, but the 31st December 2023, they said, okay, we will record the asset at market value. This will be, they already recorded the fair value, which means gain already reported in 2023, and 2023 is a taxable. This is the before tax. If the gain or the asset is already in the fair value, which means The excluded gain they consider in 2023. The 700 that we are counting in 2024, they already added in 23. So if they already added over there, so it's not taxable. Before tax, not taxable. And if we are coming here, so then we are doing the calculation. Sorry, here we are doing the calculation in this part, historical cost. But in this scenario, if recorded, then we are not doing the calculation. Why? Because 700 is already taxable. I believe you understand the concept. If on fair value, then the whatever the difference before the first tax period is already recorded in their books. So asset is not anymore on 1000. Fair value, which means asset is original cost is 1000 and this is the 700 original cost plus market fair value. So this is outside tax. So you didn't pay the tax because you already increased the asset value in books. Of course, whenever in future you will sold, you will minus the fair value of the asset. So hope I tried to explain this concept today as in very detail. Qualifying asset, the cost model, purchase before asset, purchase before first tax period. So these terms we are revising again and again, but things are remain same. So what we have to look, cost model before first tax period and expecting to sell at the gain. Example 2, valuation on qualifying immovable property. Company C has a first tax period from 1st January to 1st August 23 to 31st July 24. On 1st August, the opening balance sheet, focus on opening balance sheet showing the following in respect of the immovable property. If you want to go and see the practice, I given you the references. Just go and search the FTA relevant guideline, and they given the lot of examples over there. For practice, you can go and do that practice. Then you will understand this concept. Here we added the basic example to convey the concept. That example is little more lengthy, but is helpful for understanding the regulation. Okay, now is another example. So we are taking the original cost they given. What is that? This is the opening balance sheet. Okay, and the immovable property. The second, original cost 20 million, accumulated appreciation this, net book value is this. Now, original cost we have it, net book value we have it. 1, 2, right? And the second we are saying the opening, which means the before first tax period. Next we are saying immovable property is good to go. We are testing all these points. If we have this lens where we the lens means if we learn that what are the feature of the qualifying asset, so we are filtering that. Okay, opening means before first tax period, then immovable property, then the original cost, then net book value. All these information are required. Now they're saying immovable property was purchased when this. Okay, next, Abdullah, I don't know how you write over here, so please be careful with this. Now you have to, I don't know. Yes, be careful because I'm continuing from here. Okay. Okay, so the asset was purchased on this, on arm length, good, historical is good. So now the immovable property is the qualifying. We look all the factors are available. So now we are saying is a qualifying. In the tax return, the first tax period, company C make an election. Now they're coming toward the, because if meeting the condition of the qualifying asset, then we're saying, okay, we'll go for the election. Election. What is the election? Transitional relief under the valuation method in respect of the immovable property. We will get the valuation in the first tax period. So the normally we seen in the market the property value maybe is a 2 million. This requesting or negotiating or dealing with the valuation company make the 3 million. Why they are insisting or they're approaching them? Because they don't want to pay tax on future. Of course, if the valuation companies is not looking into that properly, so in future may face some consequences. Why? Because of course, if the material difference is there, tax authority may trigger the audit, and they have that report of the valuation company. They might the catch them also by issuing the wrong report along with the taxable person. Okay, market value at the start of the first tax period. Step 1. Company C obtain evaluation from the relevant government competent authority. We are saying in the UAE, market value of the qualifying immovable property on this is determined as 24 million. So now we have the market value is 24 million. So would you please calculate the excluded gain? Would you please calculate the excluded gain? Okay, here the step 1. The valuation is there. Now let's see upon disposal. Step 2. Yes, please. 4 million Amir Abdullah. Sorry. Okay, Amir. Let's see here. Thank you, Amir. Step 2. Company C sell the immovable property. Now we already calculate the gain. I believe the Amir is calculate the 4 million. Hope it will be correct. Company step 2. Company sell the immovable property is good. This is the one of the condition. In future we can sell at the 27 million when 31st July. So this is the in 31st July they sold during the first tax period. More likely this is coming in during the first tax period. So net book value when its net book value was 16 million. Following the recognition of depreciation of 1 million for the year. Okay. So here we are seeing they already given us the depreciation. Here was the net book value when in opening. Okay, but 2024 the net book value how much? 16 after, right? An asset is sold on the 24 million. No, asset is sold on the 27 million. This is the deemed. This is the deemed. So what is the actual sale? Yes, 27 million, right? Let me reconfirm. Yeah, 27 million. This is also in 2024. Now please calculate that and give me the figure. Apply the both method, direct method, indirect method, and then calculate the excluded gain. calculate the excluded gain. Yes, Amir. Yes, Abdullah. Prabhu. I appreciate your quick response because now, as earlier also requested, now onward keep the calculators notebooks with you. We have the practical dive in each topics where we're doing the calculation, applying the scenarios, because without practical examples, it's challenging to understand the concept. Okay, so now let's see the calculation of total gains. So sale price is 27 million, net book value is 16 million, total gain is coming 11 million. The calculation of excluded gain, the pre-corporate tax gains, excluded gain pre-corporate tax because tax is not applicable. We calculated the market value 24 million, it was provided, then we minus the net book value and the original cost. So always is required higher of. So net original cost is this, net book value was this, but we said higher of, so this is the original cost we took here. So we calculated the gain is the 4 million, right? Excluded gain market value minus R of the original, the 4 million. This is the our first gain. Now calculate of taxable gain or post gain 11 minus 4, 11 million minus 4 million, so 7 million. This is the taxable gain. So now this is the which method we opted. This is the if we are considering the direct method, right? So how about the proportionate method? Because still it's not final, we have the option to choose whichever give the more option. So now the time apportion. Okay. So calculate the amount of gain at would horizon on this qualifying immovable property. So this is the same. We are doing the proportionate. It's continue of the same. Continue of the previous example, right? So what we are concluding here, this is the first step we already calculated. Okay, 27 million minus 20 million. Okay. I'm just refreshing quickly. We have this 7 million gain, excluded gain. So this is the step one. We taken that. Now step two. Step two, divide the number of days of the qualifying immovable property owned before first tax period by divided by total number of days. So this is the formula. The number of days qualifying here owned before first tax period, because on this we said tax not applicable, may not applicable if conditions are met. May not applicable. Right? Okay, so now let's continue. We are continuing on the same. We calculated the days from this date to this date. We said this many days are coming. Why the days? Because there is a fractional difference may affect where the big gains are there, and of course these items always have the material amount. Okay, so total number of days from this to this. up to this is 1460, and the fraction of multiplication is there. Multiply the amount calculated in the step 2. See the fraction we are saying. Again, this is the fraction we already calculated. So now is coming is the 5.2 million. So that gain we are calculated. First one gain we have the 4 million as a direct method. Then we have 5.2 million as a method 2 as the proportionate. So now tax authority is saying now you have the choice. It's good thing they said okay, now you have the choice. Choose which one you would like to take, this or this. So which one would you like to take? Which one is good for us? Higher of, this is the excluded gain. Here they are not saying go with this or this. They're saying choose from here. We bring you at certain calculation. We monitored that you are not taking some extra or some untitled. So you have the option to choose. So we chosen this is higher excluded gain. Any questions so far? So this is the excluded gain. We minus from the total gain, okay? And if you're gonna see what is the taxable, so this is the taxable. Just for understanding, but while doing the calculation, we are taking the excluded gain to minus or adjust from there, and balance will be taxable. Just as the understanding, here the balance figure is also calculated. Any questions so far? Any question? This is the another example, but that you guys have to take care. So let me, but this example is on intangible asset. Intangible asset, we have the limitation of max 10 years. The second is only method 2 proportionate is available. So this is the difference. So please do the calculation. Now, would you please calculate and give me the response? See, take this pictures with you, save the screenshot, work on that, and share with me the calculation. I already highlighted maximum 10 years. This is the different point. Then I mentioned only method 2, that is the proportionate is applicable. And again, in method 2 will be higher of will be applicable cost versus net book value, higher of. Then numerator, let's say the total life is 20 and pre-owned period may be 12. So we have limit to consider 10 only, allowed maximum 10. But if we have 9 is good, but we cannot exceed then 10. Rest is all calculation. Would you please confirm you took the screenshot or picture or something, and we have separate group, you might send while after calculation your answer over there. Now let me go to the next example. Intangible asset, this calculation step by step is there. You can, okay, let me go back. Okay, back to quickly. Okay, this is the example number 4. We are saying here the step 1. I quickly just overthrow. You might review this. Step 1, then we calculated 20 minus 15,000. This gain is there. Then we have step 2. Then step 2, we are calculating the proportionate method. For proportionate, we need the number of days. So we calculated the number of days 729 and the total number of days 1095. Okay, then step 3, multiply with fraction. The fraction coming from this by this, there fraction will be there and that fraction is here. So we have the gain of this and we calculating with that. Step 2, this is the our gain. So now step 4, calculate the step amount from the excluded gain. I'm just covering the quickly. Hope you understand, but later on if you want to see the result also. So excluded gain is already with us. Calculate the taxable gain. So now this is what we needed, but now we have to calculate the total computation. So total we are summarizing sale price. This is the sale price, net book value. This is net book value. This is the gain. So now we have to minus the excluded gain. This is the excluded gain. Okay, this is excluded gain. So keep in mind what we are doing. This is the excluded gain. This is okay, and this is the taxable amount. Okay, so qualifying financial asset. This is our third and the last qualifying financial asset and liability. Company E has a first tax period. Okay, this is good. This and January. Okay. This year opening balance is coming, which means the purchase before asset before first tax period. Company A is 80, then represent 1,000 each. The cost of the shares is 10. So 10,000 they have the value of the shares. 1,000 shares, 10 per shares. So this is the cost. Now the shares in companies that are qualifying asset. These shares were brought on the stock exchange. Okay, buy from stock exchange. Then on arm length, good to go. September 23, when we purchase September, do not benefit from any other exemption or relief for the corporate tax. Did not benefit. They did not take any other benefit because when we have the shares, so other regulation may applicable. They're saying don't go other side, just follow over here. First tax return company make the election to apply the transitional relief. Now the transitional relief on qualifying asset. Company sell the on 2025 stock exchange. Per share value is this, total is this. Now the share value is reduced, is loss. So what we are saying is expected to sold in the gain, but in this scenario is a loss. Pre-corporate tax gain, market value. Okay. Since the shares are traded on stock exchange, market value at the first tax period. The market share price, they already given this 7 as the assumption. We can go on stock exchange and check on that. So total market value is 7,000. Step 2 equal to net book value. Cost equal to net book value. Cost equal to net book value. Because here we are seeing in the financial asset, the factor change, we will take the cost only. We will not take the market value. That's why they're saying cost equal to net book value. So if this in the third point, intangible as qualifying financial asset and liability, there is a no cost market value concept. They said original cost. So we are saying both are same, 10,000 for calculation. Next step, excluded gain. So if at the beginning cost and the net book value both are same, okay, so what is the market value? Market value at start of first tax period minus cost. They think cost equal to net book value, so we don't have to look into that. So here the market value was 7,000 as assumption we made. Cost was this. This is the loss. So pre-corporate tax calculation, we have the loss, and actual sale, we have the loss of 5,000. So total taxable gain are loss, total gain, excluded gain, total loss minus excluded loss. So this loss also we have to adjust this loss because this belongs to the previous before tax period. Okay. So here we have excluded gain. Earlier we are doing the minus. Here we will add because this is the excluded gain, not subject to tax. Here is the opposite scenario, right? So insert here taxing OCI. Okay, this is the other comprehensive income. Other topic will be there. This, if you want to go and read, so please read this article. Okay, guys, we covered most of with the examples, although there is a few more examples, but that we already covered. Just quickly go through this the same but different scenario, different examples. But the concept, I believe you understand. So, is there any most welcome? We are revising the same topic quickly. But if you have any questions, so please let me know. This is summarized version that we're looking for. This is the condition. We learned that historical cost, everything. Analyzation basis. This asset we learned today. This the again the same thing, but we already learned this part. And the first part, land and building, we can see one by one, but again this is the IFRS calculation. These are some standards overview today we seen, because if the standard application in our books is not there appropriately, so of course we are maybe towards the non-compliant return, or we cannot optimize. Any particular question, please? Here we already learned the revaluation model and the fair value is not the same. So which standard is dealing? So this particularly the IFRS and the different effect is there. So this is the part number 25. Day number I believe is 10 if I'm not wrong. So this is we covered. So any questions? So please let me know.
Recording stopped.
Yes, dear. Any question? And I appreciate if you please share your feedback on the YouTube and subscribe that and share with your circle that more people can learn from there, and share your feedback to them also. If any questions, so please let me know. Thank you very much. Please subscribe our YouTube channel for continuous learning, and this series continues. So far we covered almost 25 parts, and we are diving into each topic detail by detail. Thank you very much. See you again.